It is now known that the next financial year, government will spend 72 trillion Uganda shillings to meet its obligations. It is also a known fact that part of these funds are going to be borrowed. What is to be borrowed is 9 trillion Uganda shillings, and the bulk of this is going to be raised through commercial banks. The total commercial bank loan book currently is around 21.5 trillion shillings. The historical concern of the private sector, however, is that they are going to be crowded out of the loan market as banks take preference to lend to government as opposed to the private sector. This comes out of the rational thinking that lending to government is less risky since the state is less likely to default on its loan obligations. The banking industry, however, urges otherwise.
Government borrowing is just another form of financing that commercial banks look for. If you look in detail at the financial contract of the financial industry, one of the things you'll be able to pick up is that the larger proportion of loans and advances is skewed towards companies, individuals, and other entities. And from our perspective, what the government aspirations have to increase domestic borrowing, it's just another vehicle, another instrument that they can use to manage the fiscal policy. Does not necessarily mean that they'll spend all that money.
To Minister of Finance, much of the borrowing will go towards strategic areas with a bigger trickle-down effect into the wider economy.
We are borrowing for high-impact intervention. When you hear these borrowings we are making, projects, budget support is mainly earmarked for high impact. SGR, the refinery, irrigation schemes, infrastructure in industrial parks, transmission of electricity. Because if you transmit electricity and you take it to a certain area, the kind of multiplier effect it brings is amazing. If you open up the railway, you are going to see what is going to happen. It cuts cargo cost by half.
On the way forward, the banking industry remains optimistic about the economic outlook, mainly looking at the macroeconomic fundamentals, despite the challenges including depressed demand for some goods and services.
I think one of the things that we are positive or confident about, if you look at all the macros are strong. If you look at debt to GDP ratio, if you look at interest costs as a percentage of revenue collections, all these parameters are still quite strong. So from where we sit as a banking sector, as a bank that is working in the Ugandan banking sector, we are positive because what it shows is that there is a deliberate growth agenda or desire to stimulate growth, and to stimulate that growth, as government spends more, as government spends on investment. And if you look at the proportion of money that has been skewed towards capital expenditure, investment in roads, investment in infrastructure, it shows you that the spend is being directed in areas that are going to stimulate growth.
So as government looks at mobilizing debt to meet some of its expenditure obligations, the banking industry will have a tough balancing act in determining how much it lends to government vis-a-vis what it keeps aside to extend to the money-hungry private sector currently struggling with a fairly tough economic situation.